welcome to the deep dive. Today we have a critical mission. We need to translate this stack of pretty specialized market analysis into something actionable for you.
That's right.
We're charting a course through what feels like an utterly extraordinary environment. I mean, a market that's just defying all the traditional rules, wouldn't you say?
Absolutely. It's different this time, it seems.
So we need to understand the mechanics of this current melt-up phase, right? And this AI bubble strategy everyone's talking about. What do the sources say? And how's institutional capital lining up as we head towards Q4 2025?
Exactly. We're cutting through the noise, really focusing on two massive things happening at once. First, you've got the crucial sort of underlying movements from quarterly institutional rebalancing.
The big players, BlackRock, Vanguard, State
And
Street.
giants, yeah.
Yeah.
Repositioning trillions. And second, these hyper-specific cross-market correlations that are just overriding all the historical expectations we have about seasonality and market flow right now.
Okay, so the big picture here is we're not in Kansas anymore, basically. Not a normal market cycle.
Not at all. It's, as you said, kind of a steroid-fueled expansion. It feels like it's playing by a new set of rules.
Yeah, like September's meant to be weak, traditionally. But we're seeing strength, persistent strength.
So what are these new rules? Let's try and unpack them.
Okay, let's start with that institutional rhythm. Quarterly rebalancing. It's critical because these portfolio managers are making really calculated moves for the next 3 months.
Right.
Now, it might not always mean, a huge 5% drop or rise in one day, but these managers are subtly shifting billions, tens of billions sometimes.
Often away from what's done well.
Exactly. And into assets they think will lead in Q4. It's that repositioning underneath the surface that really sets the stage. And the key thing is that this subtle repositioning is happening during this continuous melt-up. That's the difference, isn't it?
Precisely. It means those old algorithmic assumptions, the idea that if something goes up 10%, it has to pull back 3%, well, that's just irrelevant right now. The momentum's too strong.
So that defiance of weak seasonality, that's the clearest signal we're in a genuine melt-up.
I think so. We've sort of moved past normal market gravity. And you see the proof in the mega caps. I mean, think about the potential for abnormality now. We're actually talking about trillion-dollar companies.
Trillion-dollar company.
That might jump, 15%, even 25% after a good earnings report.
And there's a jaw-dropping example of that recently, right?
Oh.
Oracle.
Oh, yeah. Oracle, before their report, they were around $700 billion market cap?
Roughly.
After the earnings beat, rallied a staggering 40%.
40%. For a company that size, I mean, that just tells you everything about the environment.
Yeah.
Momentum is king right now, not necessarily old school valuation.
Which brings us right to the engine room of this melt-up.
Yeah.
The AI narrative.
Right. That narrative has definitely created a bubble, very specifically in U.S. equities, which, interestingly, are really outperforming things like crypto right now.
Significantly.
So, given we're acknowledging it's a bubble, what's the strategy the sources are pushing? Do we just, sit on the sidelines and wait for it to pop?
Absolutely not, according to this analysis. It's quite counterintuitive, actually.
Yeah.
The strategy is you don't fear the bubble. You ride the expansion.
Ride it. Okay.
You participate aggressively. And yes, even using leverage. But, and this is the crucial part, it all hinges on really strict risk management.
Okay.
The goal is to capture this huge expansionary phase and only get out when there's a clear structural break that signals the trend is actually over. Because honestly, who knows when it pops? Next week, 5 years.
Right. You could miss out on massive gains waiting.
Exactly. So you have to capitalize while the momentum's there.
Now, the sources get really specific. They talk about a massive 30% risk allocation on one stock, Microsoft, MSFT, based on a high conviction setup. 30% on one equity. That sounds huge, even for high conviction.
It is huge.
Especially in a bubble context. Did the sources lay out specific parameters for this proper risk management to justify that kind of concentration?
They were very clear on that. Proper risk management here means, yes, leveraging aggressively, but defining your absolute maximum loss based on, say, a quarterly low being violated.
Okay, a hard stop.
A hard stop. And never risking more than a defined small percentage of your total trading capital on any single swing trade. The confidence for that Microsoft trade came from a calculated 9.53 risk-reward ratio.
Wow, 9.53 to 1. Explain that for people who aren't chart experts.
Sure. It basically means if you risk just $1 on the downside, the potential profit you're projecting on the upside is $9.53. That kind of asymmetry, that potential reward for the risk taken, is what justifies a heavier allocation like 30%.
And that conviction wasn't just based on Microsoft's chart alone, was it? It was tied into that cross-market harmony idea.
Exactly. The confidence that Microsoft's critical quarterly low would hold was anchored by the expectation that the Nasdaq itself wouldn't break its own quarterly low.
Which, in turn,
Was supported by the relentless strength and expansion we were seeing in the Japanese Nikkei index. The whole global algorithm was kinda singing the same bullish tune.
And zooming out even further, this analysis draws a really striking parallel to Microsoft's own history, a historical fractal, they call it, mirroring its 1996 to 1999 bubble phase.
Yeah, it's fascinating.
What did that structure look like back then, and why is it potentially so significant now?
Well, back in 96, you had this substantial initial run-up in Microsoft. Then it went into a long period of sideways consolidation, a really frustrating grind for a lot of investors at the time.
I bet.
But after that consolidation broke, an explosive 670% return into the peak of the dot-com era.
670%.
So, the idea is, if Microsoft's current consolidation structure is truly repeating that specific pattern, well, it suggests we might only be in the very early stages, the foundational stages of a potential multi-year expansion.
Meaning all this near-term volatility is just noise, not the real signal.
Potentially, yes. Noise within a much larger uptrend.
Okay, so beyond the charts, there's a fundamental story supporting this too, right? Capital expenditures. CapEx.
Absolutely crucial.
The sources really emphasize this massive increase in spending by the mega caps isn't just, random spending. It's screaming future revenue explosion.
That's exactly it. Look at Google, doubling its CapEx year over year, committing $22 billion.
$22 billion.
Microsoft, forecasting a staggering $19 billion. This isn't just marketing money. This is going into building the physical specialized hardware, the data centers, the sheer capacity needed for things like Azure and Google Cloud to handle the AI demand.
And the strategic importance of that.
Yeah.
It's about locking customers in, isn't it? Guaranteeing that long-term recurring revenue.
It's a land grab.
Yeah.
Pure and simple. If they can capture these big enterprise clients now by providing the best infrastructure for complex AI, well, those clients become captive.
Because switching cloud providers later is a nightmare.
Exactly. It's incredibly costly and disruptive. So it allows Microsoft and Google to easily upsell all the high-margin next-gen AI services they're developing down the line. They're building the moats right now.
Okay, let's widen the lens a bit. This AI race is global. And the sources remind us, 90% of the world's AI research talent is basically in the US or China.
Pretty much concentrated there, yeah.
So who's the key player to watch on the Chinese side?
Alibaba.
Alibaba.
Baba Berry. Because of all the geopolitical tensions and the restrictions on accessing high-end U.S. chips, Alibaba is basically forced to develop its own domestic chip ecosystem to serve its huge client base.
Right, out of necessity.
And technically, Alibaba looks like it's woken up. It seems to have emerged from a 4-year recessionary phase. It broke out of a massive accumulation zone, established a clear bullish structure, making its first clear higher highs supported by higher lows.
So a critical bellwether for that global AI component.
Definitely one to watch.
Okay, let's zoom back out and talk about that crucial cross-market nexus you mentioned earlier, the 100% correlation idea. Explain that link again, the key, Nasdaq Q, Bitcoin, and how we use it as a predictive tool.
Right. Think of the Nikkei, the Japanese index, as maybe the ultimate canary in the coal mine for global liquidity.
Okay.
When the Nikkei expands strongly, it signals that Asian capital and liquidity are flowing. And historically, where does that capital often go next?
Straight into U.S. tech, right, the Nasdaq Q.
Exactly, the growth-heavy U.S. equity sector. And consequently, with the Nasdaq expanding, high beta, riskier assets like Bitcoin are expected to follow suit.
So there's an interdependence. If Japan signals a rally.
It tends to reverberate across all these correlated risk-on markets. It limits the probability of a major downside move in U.S. tech or crypto because the underlying liquidity flow is strong.
What's really fascinating right now, though, is that Bitcoin is noticeably underperforming. It's lagging behind the Nasdaq Q's push. What does that tell us about where capital is prioritizing?
It tells us capital is overwhelmingly focused on U.S. equities at this moment. The AI narrative is just too powerful, too compelling to ignore right now. Bitcoin's consolidation is basically a sign that capital is waiting. Waiting for the next catalyst, maybe.
And the outlook for crypto is more consolidation until
the new quarterly candle opens in Q4. That's the expectation. But, and this is important, we have to stress that Q4 is historically, seasonally, the strongest quarter of the entire year for crypto.
Okay, so if Q4 is historically strong, how should listeners be thinking about positioning themselves for that potential crypto expansion?
Well, Bitcoin, BTC, is defending its critical quarterly low right now. It's consolidating and potentially forming a large ascending triangle. That's a classic bullish technical pattern suggesting a year-end breakout is highly likely.
Ascending triangle. Okay. But you mentioned another chart structure.
Yes, if we look at maybe the most prolific chart structure right now, it's probably Ethereum, ETH.
Ah, Ethereum. The analysis points to a really long-term trajectory, like $10,000, after it broke out of that huge 2.5-year consolidation.
That's the potential target, yes. It was a massive breakout.
So what's the precise swing-long entry strategy people should be watching for with ETH?
The key instruction from the sources is patience. Wait for the new quarter to actually open. Then we're looking for a definitive pullback to a key support level, specifically the level around 41.27.
41.27.
If the low there gets taken out, that presents the optimal zone for a swing-long entry, according to this analysis. It's about leveraging that expected seasonal strength in Q4, but trying to get the best possible price on a structural pullback first.
Makes sense. Okay, it's clear this AI engine is running incredibly hot, but engines don't run on their own fuel. What's the fundamental global force lubricating this whole risk-on party? Let's shift to the macro drivers.
Yeah, the root cause, when you boil it all down, driving all these risk-on assets higher, it's currency debasement, plain and simple.
Debasement. Explain that.
We're seeing yields, particularly things like the 10-year Treasury yield and the DXY, the dollar index, coming down.
And the DXY is just the US dollar versus other major currencies.
Exactly. So when the DXY falls, it signals a loss of purchasing power for the dollar. Your cash is worth less over time.
So if you're managing billions for an institution, or even just your own family's generational wealth, you simply cannot afford to just sit in cash.
You can't, because the institutional mandate often isn't just don't lose money, it's often achieve X% growth annually. If cash yields nothing or less than inflation, well, they're mathematically forced to take risk.
Forced into equities, gold, Bitcoin.
Into anything that offers a potential return to simply maintain and hopefully leverage that wealth against the backdrop of debasement. It's an institutional imperative, survival, really, in this kind of environment.
Okay, let's touch on commodities then. Gold, XAU, still expanding, targeting $4,000 based on a technical breakout.
Yeah, a really powerful double inside 2-month candle breakout pattern. The target is up there at 4,000. But there's a serious caution issued here, a warning against traditional trading wisdom.
What's the warning?
Well, if you look at gold's RSI, the relative strength index, it's way up there, highly overbought, near 86.
Which normally screams short opportunity, right?
Formally, yes. Traditional wisdom says, short the asset, it's gone too far too fast. But, and this is key, in a genuine melt-up or bubble environment, those traditional indicators often fail spectacularly.
They just don't work the same way.
Exactly. Bubbles can stay extended, can stay highly overbought for months, even years sometimes. So the caution is explicit. Do not short gold solely based on an overbought RSI.
So if you're long gold, or thinking about it, what's the only valid exit signal according to this view?
A clear breach of a previous quarterly low. As long as each quarterly low holds, the upward momentum is technically still intact. You have to stay with it. Don't fight the prevailing momentum based on indicators that were designed for calmer, mean reverting markets.
Got it. Okay, finally, let's bring this all back home. Long-term wealth protection against that debasement we talked about. What's the recommended vehicle for just timeless passive allocation?
The core recommendation is to maintain that long-term investment portfolio, totally separate from any short-term trading capital, and keep it invested in growth indices. The specific advice favors the QQQ, the NASDAQ Q100 ETF, over the S&P 500 ETF, SPY.
Okay, QQQ over SPY.
Yeah.
Why is QQQ seen as the superior choice for the long haul here?
Because QQQ fundamentally represents the growth sector. It holds the companies dominating AI, cloud, software, the big tech innovators.
The drivers of this future economy, essentially.
That's the thesis. If you believe, as these sources clearly do, that technology will continue to accelerate and lead global productivity for the next decade or two, then QQQ captures that acceleration much more effectively than the broader SPY.
And the performance data backs that up.
Oh, yeah. Look at the numbers since the COVID bottom. QQQ generated roughly a 263% return, SPY, around 204%.
Wow, that's almost a 60-point difference.
It's a significant delta. Over time, that's the difference between just protecting wealth and really leveraging it aggressively for long-term growth.
Okay, let's try and synthesize everything we've just unpacked. We are definitely in a unique steroid-fueled market. seems defined by high-leverage institutional flows underneath the surface.
And that AI bubble as the main engine.
Right. The AI bubble is the engine demanding participation, but only with strict risk control until a clear structural break happens. And this harmony, this correlation between the Nikkei, Nasdaq, Q, and Bitcoin is dictating global price action.
Yeah, that cross-market linkage is key.
So our focus now really sharpens onto the Q4 open, the new quarterly candle, and the upcoming earnings season, especially that Microsoft report on October 28th.
Definitely. And maybe the final provocative thought for you, the listener, to walk away with really builds on that historical blueprint we discussed for Microsoft.
The 1996-1999 fractal.
Exactly. And it's still an if, but if Microsoft's current pattern truly mirrors that structure, that long consolidation followed by that explosive multi-year 670% expansion, well, it implies we might only be in the very, very early innings of this potential generational wealth creation event.
Wow.
So knowing that markets over the long term always recover and eventually move higher, how should that high conviction historical fractal potentially influence your long-term passive allocation strategy right now?
That really is the million-dollar question, isn't it? Or maybe the multi-million-dollar question.
Yeah.
You need to assess if your long-term allocation truly reflects the potential power of that pattern and also the ongoing unavoidable need to hedge against currency debasement.
Food for thought.
Absolutely. That wraps up this deep dive into the melt-up dynamics, the AI bubble strategy, cross-market correlations, and protecting wealth in this extraordinary environment.